The markets are down again today after another wild session. Crude oil was volatile as well as the spreads begin to widen between the US and Canadian crude. Apple got hammered down again and is now in a bear market at this time, which dragged tech shares along with it. How low do stocks have to go before the government steps in? You came here for the truth, so let me unveil that for you. Today we're going to look at what has happened in the markets. I want to show you oil. I want to show you Apple. I want to give you an idea of what's happening today. So let's begin by taking a look at the markets. The top three on the right-hand side, the S&P 500, NASDAQ, and the Dow Jones. The Dow Jones finished after losing over 200 points again today. Yesterday, it looked like the markets were starting to regain some strength, but today they're using Apple as the excuse for why they had declined, pulling basically everything along with it. The NASDAQ was down almost 1%. The S&P was down about 20 points, so that's where we're at. Let's look at this. Stocks fell on Wednesday as shares of Apple rolled over and dipped briefly into a bear market before recovering. A decline in bank shares also pressured the broader market. You will see that they can use any excuse in the book that they have in order to make this look oh so pretty, or in some cases they make it look worse than it is. It could be short-term noise that's causing it, but is a 20% decline short-term noise? At the bottom paragraph, Apple fell 2.8% and briefly traded 20% below its all-time high, dipping into a bear market. That here gives us the idea that even the biggest of stocks, even the biggest company, can fall into a bear market while we still have to maintain this facade that everything is oh so great. Buy the dip. It's become a tried and true tactic on Wall Street, an approach equity investors could rely on since the financial crisis, as stocks have climbed for the better part of 9 years. And we all know that this has become the thing to say. Buy the dip, buy the dip. I've heard it a million times, but some say that no longer the viable strategy it once was, as the market environment shifts and the Federal Reserve remains on its path to quote unquote normalizing its monetary policy. They always tell us that everything is going to be okay. At the same time, they're reversing course on the policy which enabled this madness to ever get to this level. They're going to reverse course, and I believe that this will have a major and dramatic impact on equities as well as all other assets. Easy money pushed the stocks up. Easy money pushed real estate up. Easy money pushed basically almost every single asset class upward except you know what. And at the same time, we look around and have to decide, well, the Federal Reserve is going to pull back on all of that. What do you think is going to happen? It's going to stand and float in the air when you pull that crutch away? Is it going to be able to withstand the pressure that it's getting? Of course not. Apple downgraded, more iPhone estimates cut as the street starts to turn on the stock. So they got downgraded to neutral from a buy, removed its prior $245 price target. UBS cut its target. Goldman Sachs cut estimates. And that just set off a chain event that brought this stock down into a bear market. Now, what happens tomorrow and the day after and the day after that, we'll see. But I wanted to give you an idea of what has happened right here. This is the stock falling below its 200-day moving average. Never, ever a good sign to see when you can tell that this is one stock that has the entire world markets looking at it as an idea of where other stocks should be trading. There are certain benchmarks, particularly when you're the biggest company in the world. Everybody is looking at you and you have to have perfect performance. In fact, you have to have better than perfect performance every single quarter, all year, every year. And of course, that doesn't happen. But for Apple, they have fallen short of that perfection that they are supposed to have. And of course, this is what you get. Below the 200-day moving average, if it stays below the 200-day moving average for a few days, we're in for some wild ride, and it's going to be going down a lot further than that. Now, Goldman Sachs also fell here. They are right around that 200 mark. This is another stock that's been badly beaten through the year. You can see that it has, this is a year-to-date chart, it has fallen to a level of just around 200 from about 250. All of these banks, no matter how big and how important they are, they seem to have been taking a beating throughout 2018. You can take a look at the chart for yourself. If I show you even the 1 month, you can see how volatile it's been. 6 month has been volatile. Year to date, it's been down. And it just shows us that these stocks here, no matter how important this company is, their stock may not reflect their pervasiveness. Okay, that's with Apple, that's with Goldman Sachs, that applies to anything. Crude oil prices are in a free fall as fears of a supply glut mount. U.S. oil prices plummeted 7% to a one-year low of just over $55 a barrel on Tuesday, crude's worst day since September of 2015. 2015 was a bad year, obviously, for crude, but also for the market in China. We looked at the markets in the US as well, and it's not good no matter how you look at it. Bearish sentiment has seized control of the oil market. They're talking here about all the details, talking about what Saudi Arabia is doing. They're talking about what OPEC is doing and so on. There's a lot more detail in there, but I just wanted to tell you the fact that, hey, this has been weakening further and further, and it's not just oil that's losing out. Amazon stock at one point was in a bear market. You see Apple falling into a bear market. You look at the bank stocks are bear market. Everything doesn't look so rosy as the picture that is painted for it. This happens to be WTI versus Western Canadian Select. That crude is trading, if you can believe it or not, I don't know if I've put the actual numbers here. If I go to this one, at one point, it has come up from here, but at one point it was at just under $16 a barrel. It's extremely cheap in relation. How are they even digging this stuff up out of the ground? It's not as if it's easy. This is very expensive oil to pull out, to refine, to be able to get it into actually usable products. Oil traders having a bad day? You could be in Canada, and that's for sure. Because you could see that despite the fact we have $55 crude in the US, WTI, looking at the Canadian crude, it looks terrible right here, and that spread has grown just recently. Even though they've both suffered, it looks like the Canadian crude is not exactly something that people are willing to pay a lot of money for. This tells us that we have something to worry about right now. Generally, what we can see with crude oil prices coming down, we only get a small percentage of that for our gasoline prices. You know how it works. The price of oil could fall down to basically nothing, all the way to the floor, and yet our gasoline prices will come down a little bit. So we don't really see all of the benefits of it, but at least cheaper oil usually brings cheaper gas, even if it's a small amount. That would be beneficial to you and I, right? But what does it signal to the economy? It tells us that usually in times when everything is good, the engines are moving, we need more oil. That oil, of course, is a good sign that things are happening in the economy. But we don't have that right now because we have a slowdown. We can see that here. And if it continues this trend for the next, let's say, few weeks, maybe even a couple months, then we know that there's something serious going on. Look at copper prices as well. Look at industrial commodities to get an idea of what's happening. You need to look at the imports and exports. You need to look at the consumption of all these countries. We find out a little too late. So we always see these numbers after they happen. That's why in the last recession, we saw the fact that after 1 year, if you could believe it or not, of the market going into a recession, that's when they admitted it. 1 year it took them. Everybody already knew. People had been laid off. the jobs numbers were looking terrible. Even the fake statistics, all the manipulations still could not make it look good. And it took them 1 year to finally admit it. So who knows how long it'll take them this time, but we'll see. If this turns around and we start to move above our moving averages, 200-day on Apple or even on oil or anything else, then that starts to begin a new trend. We'll see. I'll, of course, have it very constant and never-ending report for you that I do here at the channel, so definitely stay tuned. After this video, I'm going to record what Berkshire Hathaway has done, what Warren Buffett has done in the previous quarter. I got the 13F. I'm looking through it, going to produce a video for you, so stay tuned for that. I will bring it to you, later on today whenever you're watching this. So if this comes at a later date, then definitely check out the next video, because we always want to track and trace what Warren Buffett has done, as well as any of the other big entities. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting the channel. So I really do appreciate that. Thank you. And if you want the financial education you were not taught in school, these 2 books have it all. You can actually flip through these books at Amazon. There's a link in the description below. It's going to be able to give you an idea of what these books are like. I've also got videos on my website, themoneygps.com, where I give you just a little snapshot of what they're talking about in there. If you're more interested in the audiobook, that's also available at themoneygps.com.